Hi. So look, as a financial manager, one of the things that you should be able to do is to look at financial statements like income statement or the balance sheet and then understand or interpret the information that is contained in them. And that's really what financial statement analysis is all about, to draw meaningful conclusions about the financial health of the company, and this can possibly give you some insight into where the company is headed as well. Now, my objective in this video is not to give you all the computations that you can do to conduct such an analysis, but what I do want to tell you are a couple of things that you should bear in mind before you even embark on that journey, before you even start looking at financial statements and analyzing them. What are the things that you should bear in mind? So here are a couple of pointers, okay? Point number one, always think ratios. Never ever think about absolute numbers. Here's what I mean. Take a look at Walmart's income statement. This is data for 2018, 19, and 20. Now, this is what I see students do. Students will look at something like, let's take selling general and administrative expense, and they'll say, hey, you know what? In 2018, Walmart had 106 million of these expenses. That increased to 107 million and then 108. Hey, it looks like expenses are increasing. Which, well, is true, right? So we do see that there's upward trend in these expenses, but drawing conclusions based on this comparison of dollar figures, or what I refer to as absolute figures, is misleading. Why? Because you're ignoring scale. What you're ignoring is the fact that over time, Walmart is becoming a bigger company, at least with respect to sales. We see sales increasing as well, going from 495 million to 510 million to 519 million. In fact, if you actually calculated a ratio where you looked at these selling general and administrative expenses as a fraction of sales, as a percentage of sales, now the picture that emerges is somewhat different. You see that these expenses were around 21.5% in 2018, goes down to 21%, goes down to about 20.9%, right? So this ratio is actually falling. There's a downward trend in these expenses. This is better. This is a better way of comparing, because you are neutralizing the effect of scale over time. So never, ever compare absolute dollar figures. Always compare ratios. It's ratios, never absolute figures. It's trivial, but very important. People make this mistake all the time. Don't do that. Point number two, look how I was talking about comparison. Comparison is very important. So that's point number two. A ratio by itself is meaningless. It's meaningless unless you are comparing it. You have a reference point, right? So for example, take a look at this ratio that we calculated. It was costs, divided by sales. And let's suppose that you calculated this figure for Walmart for 2018. My point is this. You either need to compare this with yourself over time. So you say, hey, you know what? This is the ratio, in 2018. Let me see what it looked like in 2019, 2020, so on. Here you're looking at the same ratio over time, but you are referencing, right? You're comparing. So that's what I mean by referencing, being able to compare. And when you do it in this way, where you're looking at yourself over time, that's referred to as a time series analysis or a trend analysis. So in a trend analysis, you're looking at the same ratio but then comparing it with yourself over time at different points in time. Now, the other way in which you can do this is what is referred to as a cross-sectional analysis. Sometimes this is referred to as a peer group analysis. As the name suggests, here the idea is, okay, I've got this ratio. What does this ratio look like for other people or other companies that are similar to me at the same point in time? So for example, if I've calculated this ratio for 2018 for myself, let me look at company number one, which is similar to me. Maybe it's in the same industry. Look at what this ratio looks like for them in 2018. Let's do the same for company 2 in 2018, company 3 in 2018. The key point here is that you're looking at different companies that are similar to you at the same point in time. So there's no trend, there's no time series here. It's cross-section. So for Walmart, these companies may include companies like Kroger, Target, Amazon, Costco. You could probably come up with a few more. The key point is this. This ratio by itself, if this comes out to like 21%, right? This by itself is meaningless. And we do this in our lives all the time. If you take a test and you say, hey, I got 80%. Okay, is that good? Is that bad? Well, 80% might be great if your peers only got on average 50 or 40%. Here you're doing a cross-sectional analysis to reflect on how good you did. Or you could say, hey, I got 80% in this quiz. In the previous quiz, in the same course, I had gotten 60%, and then the last one I had 50%, and then 40%. I'm improving. This 80% all of a sudden has meaning, right? Because you're getting better. But here you're doing a trend analysis, right? 80% by itself is meaningless. And again, remember this with ratios. With any ratio, you always got to have a reference point. So these are the two key points. Never absolute figures, always ratios. And even with ratios, remember that by itself, the ratio is meaningless. You should always do either a trend analysis or a cross-sectional analysis to reflect on what the ratio really is telling you. So with that in mind, we'll move on to some of the ratios that you can calculate to conduct financial statement analysis.